You checked your portfolio once, lost your stomach, and never opened the app again. Maybe it was a bad week. Maybe it was a bad month. Maybe you watched a number that represented your future shrink by thousands of dollars in a single afternoon, and something inside you said, never again. And so you left your money in a savings account, earning next to nothing, told yourself you were being responsible, and quietly decided that the stock market was something other people did. Reckless people, lucky people, people who could afford to lose. But here is what nobody told you. That fear you felt, it was not a warning. It was a weapon, and it was aimed directly at you. The stock market has been terrifying ordinary people for over a century. Not because it is genuinely dangerous for the long-term investor, but because fear is profitable for someone else. Understanding who benefits from your fear and why your brain is perfectly designed to feel it is the first step towards something that most people never reach: actual financial freedom. So let us start at the beginning, not with charts or percentages, but with your brain. Your brain was not built for the stock market. It was built for survival on a landscape where the primary threats were physical, immediate, and fatal. Psychologist Daniel Kahneman spent decades studying how humans make decisions under uncertainty, and what he found was that the brain does not process gains and losses equally. Losing $100 feels roughly twice as painful as gaining $100 feels good. He called this loss aversion, and it is not a flaw. On the savannah, losing your food source or your shelter was catastrophic. The brain learned to weight losses heavily because in the ancestral environment, losses could kill you. The stock market does not care about your ancestral environment. When your portfolio drops 5% in a week, your brain does not register a temporary fluctuation in a long-term investment. It registers a threat. The amygdala, the brain's alarm system, fires. Cortisol floods your bloodstream, your focus narrows, your palms sweat, and the rational, long-term thinking part of your brain goes quiet. This is not weakness. This is biology doing exactly what it was designed to do. But in the context of investing, it destroys wealth. Neuroscientist and author Andrew Lo at MIT has studied this phenomenon for years. In his research, he found that financial markets activate the same fear circuits in the brain as genuine physical danger. Your body does not distinguish between a bear approaching your campsite and a market downturn wiping 10% off your savings. Both feel like survival threats. Both demand immediate action. And that is the trap. Because in the stock market, immediate action based on fear is almost always the wrong action. The investor who sells when the market drops locks in losses and misses the recovery. The investor who stays the course, who does nothing, who feels the fear and ignores it, almost always wins. But staying the course is neurologically brutal. Now here is where it gets darker, because your fear does not exist in a vacuum. It is amplified, deliberately, by the systems built around you. Think about how you consume financial news. Every headline is engineered for maximum emotional impact. Markets plunge, investors panic, billions wiped out. These are not neutral descriptions. They are emotional triggers dressed up as information, and they work because your brain is wired to respond to threat signals from your social environment. When the people around you are panicking, your brain interprets that as evidence that the danger is real. Financial media has a simple business model. Your attention is the product. Fear generates attention. Panic generates clicks. A calm headline that reads, "Markets experience normal short-term volatility in line with historical averages," does not get opened. Markets plunge as economic fears spiral gets opened a million times before noon. You are not being informed. You are being activated. Researcher Brad Barber at the University of California, Davis, has studied investor behavior for decades, and one of his most striking findings is that the investors who trade the most, who react the most, who follow the news the most closely, consistently underperform the investors who do almost nothing. In one study, households that traded most actively earned an average annual return of 11.4% below the market average. The nervous, reactive investor does not just fail to beat the market. The nervous, reactive investor actively destroys their own returns. Doing less is worth more. Thinking less about the short term is worth more. But the financial news ecosystem is not built to tell you that. because if you stopped reacting, they would lose you. So who does benefit from your fear? The first group is financial media, as we just covered, but the second group is subtler and more powerful, the active fund management industry. Here is a fact that most people never encounter. The overwhelming majority of actively managed mutual funds run by professional stock pickers with research teams and decades of experience, fail to beat the simple index fund over the long run. Study after study, decade after decade has confirmed this. In any given 10-year period, roughly 80 to 90% of active fund managers underperform the index. And yet, the active management industry manages trillions of dollars and charges fees that quietly erode your returns year after year. Why do people keep paying? Because complexity looks like competence. Because a manager in a suit who speaks in confident technical language feels like safety. Because when the market drops and fear spikes, having a human being to call, someone who is actively doing something, feels better than owning an index fund that just sits there, falling with the market. That feeling of safety is what you are actually paying for, not performance, safety. John Bogle, the founder of Vanguard and the creator of the index fund, called this the tyranny of compounding costs. Every percentage point in fees paid to an active manager is a percentage point that compounds against you over decades. A 1% annual fee sounds harmless. Over 30 years, it can consume 25 to 30% of your final portfolio. You feel nothing in year one. You lose everything quietly over a lifetime. Bogle dedicated his career to this message. The simplest investment strategy, buying a low-cost index fund and holding it, outperforms nearly every complex alternative over time. But simple does not sell. Simple does not require a manager. Simple does not generate fees. Simple terrifies an industry built on complexity. Now let us talk about what the market actually does over time, because the fear of the market is almost entirely a fear of the short term. In any single year, the stock market might be up. It might be down. It might drop 30%, as it did in 2020, and recover within months. It might lose more than half its value, as it did in 2008, and still recover to new highs within a few years. No single year is predictable. No single decade is guaranteed. But zoom out to any 30-year period in the history of the American stock market, and you will find that patient investors made money, always. The market does not reward the smartest investor. It does not reward the most attentive investor. It rewards the most patient investor. And patience is a skill your brain is actively fighting against. So what do you do with all of this? The first thing you do is name what is happening. When you feel the urge to check your portfolio every day, you are not being diligent. You are feeding anxiety. Studies show that investors who check their portfolios daily experience more emotional distress and make worse decisions than investors who check quarterly. Ignorance in this specific context is not a failure of responsibility. It is a strategy. The second thing you do is automate. Set up an automatic contribution to a low-cost index fund, a total market fund, an S&P 500 fund, something simple, and let it run. You do not need to decide when to buy. You buy consistently, automatically, regardless of what the headlines say. This strategy, called dollar cost averaging, means you buy more shares when prices are low and fewer when prices are high, without ever having to feel the fear of making the decision manually. The third thing you do is reframe what a market drop means to you. A drop in the stock market is not a loss if you do not sell. It is a sale. If the price of something you want to own for 30 years drops 20%, that is not a disaster. That is a discount. The investor who understood this, who bought more when others were fleeing, is the investor who built generational wealth. The fourth thing you do is accept that fear will always be there. It does not go away. Even experienced investors feel it. The difference is not the absence of fear. The difference is understanding that the fear is not information. It is noise. And you have learned finally how to turn the noise down. You opened an app once, watched a number fall, and closed it forever. But that number was never the point. The point was time. The point was patience. The point was understanding that the system built to terrify you was built that way for a reason. and that the moment you stopped reacting, you stepped outside the trap entirely. The market will terrify you again. It always does. This time, you will know exactly why, and you will do nothing. And that nothing will be the most powerful financial decision you ever make.